Welcome to the Unconventional Wisdom Podcast with Ed Rempel, the show about the most effective methods to achieve financial security and freedom. Find out what really works. Insights are based on in-depth experience from a fee-for-service financial planner, tax accountant, Canada's #1 financial planner blogger, and your host, Ed Rempel.
Have you ever wondered how you can withdraw funds from your RRSP while reducing taxes? Joining me now is Ed Rempel, a fee-for-service financial planner and tax accountant who reviews some options and strategies to keep more money in your pocket. Ed, thank you for joining us again. You're here every single year. I'm so excited to have you back.
I'm glad to be here, Barry.
Let's dive right into things. How does the RRSP/RRIF Meltdown Strategy help to help you withdraw your RRSP with minimal taxes? I'm sure it's a topic that everyone's talked about, and I know you've talked about it many times.
Yeah, it's a cool strategy. So you basically you withdraw from your RRSP or RRIF with minimal of tax by borrowing to invest to get an offsetting tax deduction. So the investment loan interest offsets tax from the RRSP withdrawal. Okay, so and then what you do is you withdraw from your leveraged non-registered investments that you borrowed to buy for your desired cash flow. Okay, so the RRIF pays the loan, and then you take your cash flow from non-registered investments. So you choose the exact amount that you want, and that's sustainable long-term for your withdrawal. So, and you minimize tax by focusing on deferred capital gains, not income. So the non-registered investments have to be very tax efficient. So deferred capital gains are the lowest tax type of investment income. So self-made dividends are the key to the minimum tax by selling a bit of your non-registered investments every month to provide the cash flow you need.
Now, I know this sounds a little complicated, but to seasoned investors, it's probably very normal. And I'm sure, obviously, when people talk to financial planners like yourself, it sounds straightforward. But for comparison, what does the traditional RRSP/RRIF Meltdown Strategy look like for those who aren't familiar?
Okay, I'll give you an example of numbers I think which should make it clearer. So let's say you retire at 65 and you've got $500,000 in your RRSP. Okay, so what you do is you convert it to a RRIF and withdraw the minimum. So the minimum at age 65 is 4%. That's $20,000 a year. Okay, and you choose no withholding tax on the minimum RRIF. Okay, withholding tax just confuses it. So then what you do is you borrow to invest with a loan that has $20,000 a year of interest. So the same as the RRSP withdrawal. Okay, now today we get about a 5% interest rate, something like that. And so that loan would be about $400,000, so close to the size of the RRSP, of the RRIF. So so ideally you can use your home equity or get investment loans. You want to get something with the lowest interest rate and hopefully pay interest only. So now you withdraw a sustainable amount from your non-registered investments for your desired cash flow. And so let's say you take a 5% withdrawal from your $20,000 from the amount you borrow, the $400,000 you borrow to invest. That's $20,000 a year. And that's the same amount you withdraw from your RRIF, but there's very little tax on that because you're just selling a little bit. So this can start as a fixed withdrawal, but generally rises most years as your investments grow. And the 8% per year returns, with 8% per year returns, if you can get that kind of return with equity investing, this would leave you in 30 years with $1.5 million in your RRIF, $2.8 million in your non-registered investments, and $400,000 in an investment loan. So now note with this traditional way, your RRIF is actually larger, at age 90 than it is, or after 30 years than it is at age 65. But that's what the traditional one looks like.
So why should it actually be called the RRIF Meltdown Strategy? Doesn't it make more sense to call it the RRSP Meltdown Strategy?
Well, it's usually best to convert all or part of your RRSP to RRIF before starting the strategy. So the amount in your RRIF is what's melted down. So RSPs do not generally allow automatic monthly withdrawals, and there are fees for what they call it a partial deregistration for every RSP withdrawal. So from a RRIF withdrawals are generally automatic monthly withdrawals, and there's no fees. So it's just much easier and no fees to do it that way.
So I know you and I have talked about self-made dividends before, and I'll be honest with you, Ed, you and I have literally had this conversation multiple times, and it still confuses me. But I'm also not close to retirement yet. I'm not worried about that strategy. quite yet, but I can imagine people who are closer to retirement are going to care a lot more. So why is self-made dividends such an effective RRIF meltdown strategy?
Yeah, I won't go into in great detail. I have a video specifically about it. So the secret to an effective RSP meltdown is that tax on the cash flow from your non-registered investments should be much lower than on your RRIF withdrawal. So you don't want to get all interest from it because it's just as taxable, right? So you want very tax efficient. So you invest for growth. To be confident in the long-term return after taxes higher than the investment loan. So you're borrowing at, 5%. You got to make more than that long-term or the strategy's not too smart. Now, minimize tax by focusing on deferred capital gains, not income. So, and that's the lowest taxed type of investment income. So, like dividends, for example, capital gains have some preferred tax ways, but the lowest tax is if you just have investments and they just grow, you don't pay any tax until you sell them, right? And you're only selling a little bit each month. So it's only the capital gain portion of that you pay tax on. So self-made dividends are the key to minimum tax by selling a bit of your non-registered investments every month to provide the cash flow you need. Only 50% of the gain portion of the amount you sell is taxable. Now, that's essentially nothing initially. You just bought them. They haven't really gone up yet. So initially, it's basically nothing. And usually the tax is only about 5 or 10%, even after you've been doing it for quite a few years. And it's gone up a lot. So now many people think that investments must pay dividends for the interest to be tax deductible, but they don't. So interest is deductible if your investments are theoretically capable of paying income. So almost any stock market investments are generally acceptable. So when I study this, Smith maneuver with dividend strategy, where you just look for dividend paying companies, and found that you generally need to have about a 1% per year higher return than you do with just self-made dividends, where you just sell a bit each month. So that I found that to be, significantly the most tax efficient way of doing it. And you choose the exact amount that you want. And, basically the self-made dividends, if you compare ordinary dividends from dividend stocks and self-made dividends and put pros and cons, what you find is self-made dividends are better in every single way. There's actually no area where the ordinary dividend is better than a self-made dividend.
Now, you've been doing this for a while. Are there any complications with this strategy? I'm sure you've come across quite a few.
Yeah, there are 4 tricky complications to this whole RRIF meltdown, and they actually make it quite they make it a little bit more complicated to do. So now the first one is withholding tax. So to have your RRIF withdrawal pay your investment loan, you try to avoid withholding tax on the RRIF withdrawal. So now you could choose no withholding tax on the minimum RRIF withdrawal when you set it up. However, any RRIF withdrawal above the minimum will have withholding tax based on the annual withdrawal. So it's 10% if the annual withdrawal is $5,000, 20% if it's between $5,000 and $15,000, and 30% if it's over $15,000. So now the withholding tax means you should pay part of your investment loan interest from your cash flow, but you get that amount back as tax savings on your tax return. So if you're retired, you're doing your cash flow. Often you think, okay, I'm going to pay to get a bit less monthly, and then I get a refund. I'm going to use that for my vacations or my travel or something. So all right, but you're taking withdrawal, but you don't get all of the RRIF withdrawal. Some of it's just withheld. So it's just an annoying complication for it. The second one is that the minimum RRIF rises. It changes every year. It's not a static number. So the minimum required RRIF withdrawal rises every year based on a formula. To have your interest deduction offset your RRIF withdrawal, you would have to increase your investment loan every year. So the minimum RRIF, so at age 65, it's 4%. At age 70, it's 5%. At 75, it's almost 6%. At 80, it's almost 7%. And then, but by age 90, it's about 12%. So if you take, from 65 to 95, take a 30-year period, the average is about 7%, but it starts at 4%. Now your options with a rising RRIF. So one is just be happy with the interest deduction offsetting the withdrawal from year one, but not at the increasing withdrawals. That's one way. It's still a good deduction. Another option is you get a larger investment loan every 5 or 10 years, or it's probably too much to do it every year, but you keep getting larger investment loans with interest that offset the increased withdrawal. So they set it up, change it every year. So the strategy offsets the tax on the RRIF withdrawal for quite a few years. So now, if your investment loan is a secured credit line against your home, you can just increase that every year. So it's much easier to do it that way. So my advice here is don't worry about getting a perfect withdrawal. Just get an interest deduction that could offset, much or quite a bit of the RRIF withdrawal. And, you save tax anyway. So it doesn't have to be perfect. And also, you don't necessarily, want to get too massive of a loan if that's not suitable for you. The third complication is the investment loan might slowly become non-deductible. So we call this the Smith-Snyder calculation. So when you take self-made dividends, or you take any withdrawals from non-registered investments that you borrowed to invest, the investment loan can slowly become non-deductible. So the interest is deductible based on what's called the current use of the borrowed money. So, for example, you borrow to invest, and then let's say you borrow to invest, and you cash in the investments and spend it. Well, then that loan interest is no longer deductible, even though you originally bought investments. The current use is you spent it. So, withdrawing from your investments for your lifestyle can reduce the interest deduction. However, it remains deductible if the withdrawal is either taxable or is used to pay the investment loan interest. So you can look at how much taxable investment income you get, or you could withdraw from it to pay the loan interest. Now, to keep your investment loan fully tax deductible, withdraw only the amount of the interest or less from your non-registered investments. So no, it's the RRIF withdrawal that's paying the interest, but keeping the non-registered withdrawal for your cash flow less than the interest keeps your investment loan fully tax deductible. Okay, so with self-made dividends, you can withdraw the exact amount you want for your lifestyle. This is normally more than the investment loan interest, especially after a few years. So this means you would need to do this Smith-Snyder calculation to calculate how much interest is tax deductible, is still tax deductible each year. So, and it is somewhat complex, but essentially it tracks the amount of your investment loan that's deductible by reducing the withdrawals that are not reducing it by the withdrawals that are not taxed as capital gains or dividends, or used to pay the investment loan interest. So it's a kind of a complication, but we have a big spreadsheet that we use to calculate all that. The fourth complication is you need a large loan to make this really effective. So, it's got to be quite large. So to offset a RRIF withdrawal, you usually need a loan that's around the size of your RRIF. So, and if you want to actually melt down your RRIF, they call it meltdown, it's supposed to decline, the loan actually has to be quite a bit larger than the RRIF. So a large investment loan must be suitable for you based on your risk tolerance, and it's advisable to commit to a minimum of 20 years when you're borrowing to invest for the RRIF Meltdown Strategy for you to have a high chance of success with this strategy, because it's the borrowing to invest part. This is because the stock market is generally liable over long periods of time. And you have to qualify for the large investment loan. Ideally, this could be from a secured credit line against your income, against your home, or since that's the lowest interest rate. Now, if you get an investment loan, make sure it's a no margin call, like an actual investment loan. Make sure it's a no margin call loan, because you don't want to have a margin call anytime in the next few decades. It can kind of wipe out the whole benefit of the strategy. So those are the four tricky complications. So they make it much harder to kind of, it sounds like a nice, easy concept, but implementation can be kind of tricky.
So this strategy sounds great, but why doesn't the traditional RRIF meltdown actually melt down your RRIF? Like, you've obviously created this for a reason.
Yes, you think it's going to melt it down. That's the title of the strategy, right? Except, the minimum RRIF withdrawal is lower than the long-term returns of the stock market until you're well into your 80s. So if you're investing mainly in the stock market, then you expect your rate of return to be higher than your RRIF withdrawal. Okay, so that means the RRIF is still growing. With the traditional RRIF meltdown strategy, you usually withdraw the minimum RRIF. If your RRIF investments are mostly or all equities in the stock market, your RRIF should continue to grow over time. So, stocks may be 8 or 10 or whatever it is, and you're taking 4% out, your RRIF is still growing. So now, if your investments are balanced, stocks and bonds, or like a balanced fund or that kind of thing, or they're much more conservative, then you maybe aren't making more than 4%. But if you're that conservative of an investor, then you likely don't have the risk tolerance to do a big investment loan. For more unconventional wisdom insights, follow this podcast and share it with your friends. I sometimes refer to a chart or image. Don't worry, if you want to see the chart, it's on my YouTube channel in this video with the same name. You can be the first to receive all my new podcasts by subscribing to my email list at www.edrempel.com. My services and costs are at edrempel.com/help. You can request a free 30-minute consultation at edrempel.com/talk or share feedback and topic ideas at edrempel.com/feedback.
Are there any complications with the strategy if you plan to retire early you plan to implement it before you retire?
Yeah, that's interesting. If you're actually going to do it, there's a big question of when. And before is actually generally makes more sense, but it can be a little bit awkward. So the RRSP meltdown is generally not worth doing if you are contributing to your RRSP at the same time. It doesn't make sense to put money in and take it out in the same year. So withdrawing from your RRSP while you're still contributing does not make sense. The withdrawal partly offsets the contribution, and you lose the RRSP contribution room. For example, if you're contributing $20,000 to your RRSP every year while withdrawing $10,000 for the RRSP Meltdown Strategy, you'd be better off just contributing $10,000 to your RRSP and using $10,000 from your cash flow to pay the investment loan interest. So this is the same cash flow and the same tax deduction while keeping more of your RRSP contribution room. So if borrowing to invest is a suitable strategy for you, it's best to start this long before you retire. For example, you could start the Smith maneuver decades before you retire, capitalize the interest, or pay it from cash flow. Like continue to make your RRSP contributions as normal based on your financial plan, but don't actually withdraw from the RRSP or start the RRIF meltdown while you're contributing. So it's this whole concept idea of like starting leverage much earlier, like having the Smith maneuver and then morphing it into the RRIF withdrawal when you retire works beautifully.
So how about implementing the strategy when you actually retire? Does that make sense? Any complications?
Yeah. So the issue there is you think, what's what I do? I just convert it to a RRIF. Now I'll just go get my big investment loan. But taking a large investment loan when you retire might not be suitable for you. It's essentially this is especially true if you've never borrowed to invest before that. So you've never borrowed to invest, and now all of a sudden you're going to go out and borrow $500,000 to invest. Like is that really a smart strategy for you? It might be, but it's you got to think it's new and it might not be suitable. So for this strategy to benefit you, the investments need a long-term after-tax return higher than the interest after tax. So this generally means your stock market investments, which go up and down and sometimes have a large declines. The strategy only makes sense for you if you're going to stay invested when investments fall, stay invested long-term. So it's advisable to commit to at least 20 years if you do the RRIF meltdown strategy. This gives you a high chance of success because the stock market's usually pretty reliable over long periods of time. I've done a few videos specifically on that topic. But yeah, you got to go out and get this big honking loan when you retire.
So we've been talking about loans for a little bit while. Not everyone's comfortable with that. Are there other RRIF meltdown strategies that you would advise?
Well, there's different variations of the RRIF meltdown. All of them involve loans. Okay, but it's a question of what are you trying to actually accomplish. So there's the traditional one, which we kind of went through already. So in this one, basically the interest deduction offsets the starting RRIF withdrawal for year one, but usually you're not increasing it in the traditional one. Okay, and so the RRIF rises more slowly than it would if you weren't taking some out, but it still rises. And, it's the example we had before. Remember, we started with retired at 65, they have a $500,000 loan and you're taking $20,000 a year out. You go get a $400,000 loan and you end up at the end with your RRIF is around $1.5 million. So it's actually ends up quite a bit higher than when you started, but you've got a fair amount out of it without tax. The second strategy is that I call it the tax-efficient RRIF Meltdown Strategy. That's the traditional. This is the tax-efficient one. So the tax-efficient one, so the interest deduction offsets the rising with RRIF withdrawal over the years. So you try to keep up with, as your RRIF withdrawal keeps rising, you're trying to get an interest deduction large enough to offset it. So you set your RRIF withdrawal based on the minimum RRIF 5 or 10 years from now, or take the average minimum RRIF over the retirement, which is about 7. So it means it's usually taking, instead of taking 4% out, you're taking 5 to 7% of your RRIF out each year. And so you're trying to offset interest for many years. Now, to do this, your investment loan would need to be larger. So, for example, same case, you're 65, you have a $500,000 RRSP, and you want to convert it to a RRIF, and now you're withdrawing 7%. That's the average RRIF withdrawal from 65 to 95. So 7%, you're taking out $35,000 a year. Again, you choose no RRIF withdrawal on the minimum, but there is withholding tax on the amount above the minimum. The extra 7%, only 4% is can there be no withholding tax? And then, so now you want to borrow to invest with a loan that has $35,000 a year of interest to offset it. So with a 5% interest rate, that's a loan of $700,000. So your RSP is $500,000. Now you're borrowing $700,000. It's a bigger loan. So ideally, use your home equity to get an investment loan, and the rest part I have to say, you withdraw a sustainable amount from your non-registered investments. It could be 5%, which would be you're taking $35,000 out to spend this way. So now this can start as a fixed withdrawal, but generally tends to grow. And now again, so if you have let's say your investments make 8% long term. 30 years, you end up with $600,000 in your RRIF, $4.9 million in the non-registered investments, and $700,000 investment loan. So in this case, what happens is your RRIF is about a similar value to, or it could be to what it started off with. So in this case, it started with $500,000. 30 years later, it's $600,000. So, and this way, you've tried to offset as best as you can all the tax from the RRIF withdrawal, but it's a bigger loan. Now, then there's what I call the effective RRIF meltdown strategy. So this is where you actually melt down your RRIF. So what would it take to actually melt it down to zero? So you need an investment loan large enough to melt down your RRIF. So here you set your RRIF withdrawal high enough to melt down your RRIF during your retirement. This means a withdrawal rate roughly 15%. Okay, so your investment loan would need to be much larger. So in this example, so let's say you retire at 65, you have a $500,000 RSP. You convert it to a RRIF and withdraw enough to melt down your RRIF during your retirement, which is, so in this case, if you actually want to melt it down, it's about 15% a year. Now it depends here on, how you invest, what rate of return you're expecting. But I'm putting that as, if you're making it's 8% long term, you got to take about 15% out if it's actually going to use it up by the time, over 30 years. So again, you choose no withholding tax on the minimum, but which is 4, but the other 11 will all have a whole bunch of withholding tax. And now you're trying to borrow to invest, and you want a loan that has $75,000 a year of interest. So because that's how much your RSP withdrawal is. So now with a 5% interest rate, that's a loan of $1.5 million. Okay, so that's 3 times. You have $500,000 RSP. You're borrowing 3 times the amount. So that's why you don't try to melt down the RSP. If you actually want to melt it down, you got to get this massive loan. It's funny how the math works, So again, you withdraw a sustainable amount, and you're living, pretty comfortably this way, but it's kind of an awkward way to do it. So if you do this a projection 30 years out, your RRIF would be down to 50,000, so it's almost gone. But you've got $10.5 million in your non-registered investments and $1.5 million in an investment loan. So it's all the same. It's a similar strategy with concept with much bigger loans, but usually actually melting it down is a little bit is kind of crazy, just because a loan has to be so large.
So with the loan being large, are there any concerns when implementing the strategy?
Yeah, so the RRIF Meltdown Strategy needs to make sense for you. It's best done as part of a full retirement income plan and as a continuation of leverage strategies that you started earlier. There are more factors in deciding on the optimal RRIF withdrawal than just making the strategy work. It's, so, and the same is true with whether or how much you should borrow to invest. There's other factors involved. So it's not just, let's do a math on how to minimize the tax. There's more involved, in deciding exactly how you should do it. So it's got to fit with your plan. You got to provide enough cash flow. It's got to be suitable for you. And if borrowing to invest is a suitable strategy for you, you should start it long before you retire. Like it really is, then, why you would do it way sooner. The most effective method is to start a version of the RRIF Meltdown Strategy when you retire after doing Smith maneuver, or leveraging years before. This again, do Smith maneuver for years, convert your home to tax deductible, and then morph into RSP, the RRIF withdrawal, after you retire. So you're getting a lot of that RSP out with little tax. That's probably the most effective way. So in the Smith maneuver, you capitalize the interest as long as you're working. You just keep compounding the interest, and then when you retire, you keep your investment loan, or just keep the investment loan and use your RRIF to pay the interest.
Okay, so a lot of people watching are probably interested in this strategy. What are the steps to implement it effectively?
All right, so there's 6 main steps and a couple options. So first step is start a leveraging strategy. So this is how to do it most effectively. Okay. We talked about it, 3 different methods of doing it. But I think the most effective way is you start a leverage strategy years before you retire. So for example, do the Smith maneuver on $1 million home before you retire. Retire with a mortgage that's fully converted to tax deductible credit line or mortgage of, let's say, $800,000, because the bank gives you $800,000 of it. Then when you retire, convert enough of your RSP or RRIF so that the minimum withdrawal pays the interest on the investment mortgage or credit line so it pays the tax deductible interest. Note that you have the leverage first, and then you withdraw from your RRIF to pay the interest. So it's better than starting with a RRIF withdrawal and then going out getting investment loan, after you retire. Then you set up, self-made dividends from your Smith maneuver investments or the investments you bought to invest for a sustainable amount to provide the desired retirement cash flow as part of your retirement income plan. So it's got to provide for your cash flow and be an amount that's not, that shouldn't run out too soon or while you're alive. So then every year you transfer more from your RRIF so that the minimum RRIF continues to pay the deductible interest. So, and this depends on the strategy, but often you can initially open the RRIF and transfer part of the RSP over, but it's just enough so that the minimum RRIF will cover your interest, and you transfer a bit more from the RSP to the RRIF every year. Then the year you turn 71, you have to convert the rest of your RSP to RRIF, and then the minimum withdrawal is likely now more than the amount of interest from your credit line. So your cash flow is short by the withholding tax, which you get back as a tax refund at the end of the year. Then you have to do the Smith-Snyder calculation to claim the slowly declining interest that's still deductible each year on your tax return, but you get best is get a tax person that knows how to do all that. Then, depending on which strategy, like whether you took the traditional or the tax efficient or the effective RSP meltdown, so there's a couple options. So what I just talked about is for the tradition. One option, if you're doing the tax efficient RRIF meltdown strategy, then you reappraise your home or increase your credit line or increase your investment loan when your minimum RRIF withdrawal is higher than the loan interest. So you're just keep increasing it. Option 2, if you're doing the effective RRIF withdrawal, where you actually melt down the RRIF, then you increase your investment loan so it's large enough to melt down your RRIF. So you start with a much larger one. So that's basically the 6 steps to do it, and then a couple of options.
Okay, Ed, this was very interesting. I'm sure a lot of people want to learn more or possibly get in contact with you. So what's the best way for them to reach you?
Yeah. Okay. So I have a blog which is called Unconventional Wisdom. It's actually the #1 blog in Canada for a full service financial planner. It's just my name, edrempel.com. It's also unconventionalwisdom.ca because we're in Canada. We offer a free 30-minute consultation if you're thinking potentially talking to us, and it's just edrempel.com/talk. Also, if you subscribe to my blog, I have a blog, YouTube channel, and podcast. If you subscribe to them, all that means is you get my weekly video, which comes out every Thursday. Podcast is edrempel.com/listen, and YouTube is edrempel.com/watch.
Okay, Ed, thanks for joining me on the Canadian Financial Summit again this year.
All right. Great to talk again, Barry. Always fun.
Thank you for listening. For more unconventional wisdom insights, follow this podcast, give it a review, and share it with your friends. Be the first to receive all my podcasts by subscribing to my email list at www.edrempel.com. My services and costs are at edrempel.com/help, and you can request a free 30-minute consultation at edrempel.com/talk. I often cover listener questions, so if you have a burning question or topic on which you'd like to hear unconventional wisdom, please ask or share feedback at edrempel.com/feedback. See you next week.